because this comes from after the spike futures-driven bottoms made on the 13th of May. That was gold futures, that was 1785. And in silver futures, that was 24.20, I remember.
I know we usually pick up the thread from the last episode. It's been 2 weeks now, and we'd like to sum up maybe the short-term action, and then we'll look at the wholesale markets. And what are you seeing right now? Where can you start off this episode based on what's happened just over the short 2 weeks that just passed?
Yeah, it's amazing how time flies. Nice to be with you again, Shane, and nice to be with everybody again for an update. So let's, absolutely, for consistency, let's start by just stepping back from this very short-term paper-driven chart chatter to focus on a discernible change in behavior. And you think, well, hang on, there's no change in behavior. Look, no, if you pull back, actually there is a change in behavior. And it's something, obviously, from a wholesale market, paper market perspective. And we've seen this particularly, and this is like really top down, because this comes from after the spike futures-driven bottoms made on the 13th of May. That was gold futures, that was 1785. And in silver futures, that was 24.20, I remember. Now this change in behavior was kind of reaffirmed following the very first liquid session of the second quarter. Now, if you think, we've only just literally this week, really on the 7th of June was the first liquid session of this end of quarter. And although the subtle change in behavior has not filtered through into the spec-driven specs driving the downside momentum yet, we can see that multiple times now. The expected structural change in stance from a sell the rally to a buy the dip stance is being driven actually by commercials running out of sufficient speculative open interest to lend. Now, bearing in mind you're talking about a futures market where you have to borrow the chips from the casino. Well, there comes a point where you literally you're limited to the amount that you can actually borrow. So they're running out of these chips to lend to incentivize this huge herd of blinker traders who really consider they're trading chasing a dot on a screen, and they're chasing price lower. Why? Because they're rigged to do so. And we'll look at that in a minute as to how that works. But looking at the footprints ahead of last week's CPI data. Now, obviously, this is where we need to, if you don't wait 2 minutes and we'll get over this technical stuff. But essentially, into the CPI data, we warned in the previous episode, there's a massive short position above the market spec that is ready for a squeeze. And so insiders basically had been employing bid pulling tactics, but those alone were notably losing sufficient traction to really equitably load more shorts onto the specs. So conversely, the spec short stops above the market were looking extremely attractive, like we said last time. And sure enough, the anticipated strong CPI print, which we said would probably trigger a rally, which did, was the first really of several catalysts for the house to pull the trigger on this first layer of very low hanging spec short stops last Friday. Now, sure enough, this Monday, following insider bid pulling ahead of FOMC today, which is Wednesday, it's FOMC upcoming this evening, specs who chart painted these algos are completely blinkered to a very strong central bank and sovereign physical gold market demand. And they dutifully knee-jerk, reacting to a strong dollar and rising bond yields, selling paper. They auto-sell both gold futures and silver futures into what they just see as net bearish paper-centric crosses, because there is no physical as far as they're concerned. So bottom line, following this two-way rinsing of spec shorts and then long stops, the casino is back to where it was just before they'd run out of open interest to lend to the specs into last Friday's CPI lows. after which the first leg of the upside short stop rinse commenced. Here we are, deja vu. Having profitably rung the register on extremely wrong-footed spec shorts following CPI, this inverse two-way long stop rinse began at the Monday open, so coming down, hunting those stops, which obviously the shorts had been rinsed, so they'd gone long, and now they were rinsed back on the downside. And what that did was just literally enable them. There was just enough open interest to lend these shorts out to the specs, driving both gold and silver futures into an actionable backwardation. We talked about backwardations. This should not be happening in a futures market. You should not have a futures price that's less than the cash price today. And it forced the pit managers, these backwardations forced the pit managers, which we may as well call them that, the casino pit managers, to basically take the long side, the other side of these spec short bets once more as they were rigging the price lower. Now, FOMC volatility aside later today, this two-way short rinse followed by the long stop rinse has profitably reset the house books. The attraction to rinse spec short stops again is building.